In today's video, we're going to go over some real life examples of mortgages we have done recently. Some of which we have sold and some we still have on our books. We felt it was necessary to give our borrowers and investors, both, some clear insight into how we think, how we approach a situation to make the borrower happy, but also to satisfy the sellers of the property. We have to deal with the title companies, we have to deal with appraisers and so on and so forth. So that makes it imperative that when you're dealing with business mortgage borrowers who have custom requests, that we do our best to use flexibility, creativity to give them a custom product. All the while making sure that when that product is done, our investors understand why things went together the way they did, and they have to be able to understand what our thinking was. So I think it's important that whether it's a borrower or investor who are both our customers, they have to be able to relate or identify with what we do. I think the best way to do that is to actually use some examples. These are all real life examples, again, with borrowers that we've dealt with recently. Okay. First of all, what you're not going to see is a lot of borrowers who call us who want to borrow against their property to a higher level, such as 65% of the value, 70%, even 80% of the value. When that is their request, we have two choices. We can either say we have to get the value down to our company maximum, which is 55% of the value of the property, either by the borrower putting more money down or borrowing less if it's a refinance, or if it's a purchase, the seller can step in and hold a mortgage to make up the difference. Now those are just two ways off the top of my head that we use. Sometimes they put in another piece of property to bring that loan to value down. But if we're not able to do that, we do not fund those loans. So you're never going to see a mortgage like that on our books. If you're an investor, rest assured it's always going to be 55% or less. When I'm describing these mortgages, my hope is that you get a feel for our creativity and our flexibility in trying to really make the borrower happy. That is becoming a rare commodity these days because most mortgage companies adhere to a formula. They just simply put people through the assembly line, plug them into the formula. If it works, it works. Yes, they can make some minor changes, but they're more tweaking than actual flexibility. The day when people really strive to reconfigure things to a point where it's actually very customized are becoming very rare. Very hard to find people who can do that. But that is something we do every day. So I'm going to use some notes I have here, and I'm going to go over actually 9 examples, and I'll try to make them quick. And I'll try to give you an idea what the borrower's request was and what we did about it. The first one was a local realtor. They're also investors in that they hold a lot of rental properties. They've been doing it for a while. They came across a situation where a seller wanted to sell 11 duplexes. Now, those duplexes, some of which needed a lot of work, they were all in one neighborhood. Now, some of them needed roofs, air conditioning, flooring. Some of them needed it all. And as a result, the seller was giving them a good price at $700,000 for all of them. Now, they came to us, and quite frankly, the banks would never do something like that. And B, your typical conventional mortgage company doesn't even have a program to do that. The only other option they had was go to a bank and get a commercial loan to do it. However, with some of the properties needing work, rightly so, they realized the bank wouldn't do it. So we looked at the situation and we looked at their application, of which included all the properties that they own. And we said, okay, we understand that you're going to be coming into some money by selling some properties within the next 6 to 8 months. So we need to find some way of financing this where you can pay it off, at least a portion of it, without a prepayment penalty. So what we did was we broke the $700,000 into two pieces of $350,000 apiece. On one of the loans, we took the properties they were buying and we added some properties they already owned. They didn't need to individually refinance those other properties. All they had to do was include them in our mortgage. So one of the loans for $350,000 included other properties. And we got it up to the point where we were loaning 55% of the value of all the properties. Okay? On the other one, we did another slightly more than $350,000 because we wanted to escrow some money for repairs, so we added some properties on top of that. So as a result, and we closed this in 15 days, which no one else could really do. They bought all the duplexes. They bought them at a very reasonable price, and actually they benefited almost $30,000 to $35,000 per duplex as soon as they bought them, because they bought 11 at a time, they got them underpriced. So they benefited by at least $250,000 when they bought them. It's instantly. And as a result, they were buying the lion's share of the duplexes in that neighborhood. So once they got all their properties done to the point where they were in good shape, they raised the rents in that neighborhood for everybody. And now they're in the process of buying most of the other duplexes in that neighborhood, at which time they're going to put a gate up front and they're going to be able to control the neighborhood entirely, which is really a dream come true for a landlord. So we did that loan, closed it in 15 days. The rate was in the high 8s. We gave them 30-year fixed with 9-year balloons or 10-year balloons. So they were tickled pink on that. That really worked out well for them, and they pay it perfect. The next one was a gentleman who came to me to buy 4 rental homes from the same seller. And as it turned out, he goes to an investment club meeting once a month, and the same lady for the last 2 or 3 meetings was standing up and saying, I have 4 homes. Unfortunately, on some of the homes, I owe a little more than they're worth, but I need to sell them because I'm moving back to Maine to be with my daughter who just had twins. So I want to sell my properties and I want to move back to Maine. But of course, everybody in the investment club is saying, well, I don't want to pay more than they're worth. That's not a good investment. So a gentleman up there that I've dealt with for years called me and he said, Jeff, we know you guys are creative. What do you think we can do? Well, after getting some understanding of the seller's situation, we recommended the seller go out and get a credit line she had on her house. She didn't know anything on her house, so she got a credit line. And we said, well, regardless, she needs to pay the balances down to the point that down to the value of the property, which she did. And then we went ahead and we did our 55% loan to value mortgages on all four, and she held a second mortgage for the rest. So she sold all the property. She was able to move up to Maine. She's holding a second mortgage, so she's got collateral on the properties, and we gave her the bulk of the money she needed. Her loans got paid off. She no longer had to worry about rental properties because she sold the properties. Now, a very good buyer bought him. He's got very good credit. He's a seasoned landlord. He's taking care of everything, and he's making payments to her on her second mortgages. She moved up to Maine. Everything worked out. So, again, no one else really had the capacity for doing that. At least when he called around, no one else would. So I'll use that as proof that we were unique in that. Lady called me. She was a referral from one of my Tampa customers, and she had just got out of a Chapter 13 bankruptcy. Now, a lot of lenders would look at that and say, oh, bankruptcy, I'm not interested. When you really look at her situation, you start to realize one thing. When her debts got out of control, actually what happened, it was medically related, but that, of course, affects you being able to pay your debts as well. She did not take a Chapter 7 and just have all her debts extinguished. She went to the trustee, the bankruptcy trustee, and she worked out a payment plan. And she struggled for 3 years making $3,500 payments, which was a struggle for her to pay off all her creditors, which she did. And when she came to us, she said, for the last 3 years, I've been neglecting my assisted living business that she runs in Tampa, and I need money to do some improvements, upgrade some things. In terms of mortgages, it wasn't a large mortgage. It was $75,000. But I look at her and I say, what would happen to a borrower when they have to have a triple bypass, and it was $250,000, and for some reason they didn't have insurance at the time to pay for it? What would they do? Very often that borrower, no matter how good their credit was beforehand, is going to go to bankruptcy court and say, I can't pay that. I'm just going to extinguish all my debts. Well, in this particular case, she could have done that, but she didn't. So to me, that is a big plus in the character category. Because again, we use our 5 C's of credit before we approve a loan, and character being one of the most important factors. But she looked bad on paper, but from a character standpoint, she proved to us what she was made of. So we still kept the loan under 55% loan to value, gave her the cash she needed. She made the improvements she needed to make, and she brought some new people into her assisted living, and ever since then she's doing great. Next one, we have a gentleman and his sister who were pulling their money together and buying some investment homes. They were going on to the foreclosure auctions, that sort of thing. Well, they bought a property, and they bought it under value. It was up in the Crystal River section of the east coast of Florida. The west coast, excuse me. And it turned out, when they got the property done, the brother looked at it and said, well, I'd love to live there, but we do not do owner-occupied properties normally. They're done under an exception. But in this particular case, he was a great borrower, good guy. He could buy the property reasonable from his sister. So what we did was, one of the exceptions on owner-occupied properties that help us in doing the financing of those sorts is if the seller holds a mortgage, that mortgage is exempt from all the real difficult owner-occupied regulations. So what we did was, we approved the buyer to buy the house. We typed up the mortgage and we put the seller's name on the mortgage. And she actually closed everything and sold the house to her brother as the seller holding the mortgage that he needed. And then what happened was, our attorney turned around and had her sign an assignment of mortgage. So we bought the mortgage right at the table. So she got all the money she needed, and in that way, we're holding a loan for a gentleman who is going to live in the property. Normally we don't do that, but using one simple extra step, and we got that done, and everybody was happy. The fifth scenario, a lady called me who had a lot of experience running assisted living centers, almost 20 years of experience doing that. And she'd gotten frustrated because she really wanted to run her own. So she called me and said, I have $20,000 to put down. I found the perfect house in Florida for an assisted living center. Matter of fact, it had already been an assisted living center. But the price was $195,000 for this house. And in our book, $20,000 down was insufficient. Remember, she basically had to get to the point where she was putting 45% down, which was a lot more than $20,000. So in speaking to her, she mentioned that she currently had a lady in her house that she was taking care of. She was a 61-year-old lady who had some health problems, and in any case, she was paying my borrower $4,500 a month for her 24/7 care. And in the course of the conversation, she mentioned that this lady's family was well-to-do. So we got to talking about it. And I suggested to her, I said, why don't you go to the family and see if you can trade that month-to-month $4,500 fee for a lump sum for a longer period of time. In other words, I'll take care of your mother for 10 years at zero cost per month if you advance me $133,000 that I need. And that is a great savings for the family, but it also gives our borrower the money she needs to buy the house and do some improvements. So she sat down with the folks. It made perfect sense to do that. Of course, she'd move their mother with her when she moved to the new property. And they agreed. And they actually gave her $133,000. We verified it went into her account. Now, she used part of that money for down payment to buy the property. And she held the rest in reserve to update the sprinkler system in the house, because as an assisted living center, you have to have the sprinkler system. So the original $20,000 she had, we used that to pay off all the credit card debt she had that she used to improve the house she was living in, because we wanted to strip her of as much debt as possible because she was going into a new venture. So her new payments were almost $1,000 on the assisted living center she was buying. We took the funds she had and we paid off credit card debts, which lowered her monthly outgo by $850 a month. So as you can see, there was only a $150 a month difference. So she's getting her assisted living center, which was the perfect place for her. She now has the ability to put 6 people in that center. And we paid off her debts. And now her net cost for doing all this was $150 a month. So obviously we made something happen there, and everybody was happy. Matter of fact, we sold that loan not long ago, and the investor who bought it was tickled pink. That rate was in the high 9s, 30-year fixed, again, with a 9-year balloon. So that worked out fine for her, because once she gets her assisted living center full of people and she has a couple of years of track record, she can get a normal refinance at a lower rate, because we're probably going to do it for her. We had a gentleman who in 2008 had a situation where he went to his bank, it was Chase Bank, I believe, and he said, I lost my job, I got laid off, so on and so forth. Wondering if you can work with me. They said, well, we can't work with you until you let your payments fall behind. Once you do that, we have a program to help you. which he did. And as it turned out, when his payments went behind, the program turned him down and he wasn't able to get caught up. So Chase had lawyer fees and they had all kind of charges and so on and so forth. This is a man who had perfect credit. So as time went on, the balance that he owed on this property was probably double what the property was worth. In the meantime, he was taking his payments based on what his lawyer had told him, and he was setting the money aside in a separate account. But Chase would not work with him. So he came to us and said, listen, Chase is going to take my house sooner or later. I need to find another place. So he found the perfect place, a house on some acreage. But that particular house could only be purchased cash because it was a foreclosure. It was in pretty good shape, just needed a little bit of work. It was a foreclosure, and they would not allow anybody to try and buy it getting a loan. So he wanted it. He had a lot of money to put down, but he didn't have all the cash. So in order to be creative and flexible, we said, okay, here's the situation. We're going to buy the house, which we did. So we bid on it and we got it, of course, with his approval. But first, he took the money he was going to use for down payment and he put it in our lawyer's escrow account. And we drew up an agreement saying, whatever we pay for the house, we're going to have a small upcharge. And it was small. It was like $3,000 to cover our costs and insurance and that sort of thing. And we bought it. As soon as we had deed to the property, we turned around and sold it to him. He used the money from the escrow to use as a down payment, which brought us down to 55% loan to value, and he got the property he wanted. He deeded the property, his old property, over to Chase, and he was done with the situation. So even if you're flexible and creative, most lenders do not buy a house in order to sell it to you. But the situation made sense. We were safeguarded by the money he put into escrow, and he was safeguarded knowing that we were putting our money into buying this property. In this particular case, I'd have to say we went above and beyond, what you could expect most lenders to do. But it was a perfect solution for him. We were always protected, and it made sense. Like we say, if it makes sense, we do it. In this case, it did. The next scenario, request we got from another local realtor, a gentleman I know pretty well. He was looking at a duplex, not far from our office, actually. But the duplex needed a lot of work. As a result, he was buying it cheap, but it needed a lot of work. It needed a roof, needed siding, needed windows, interior, some wiring, siding. It was a big, big job. And people he knew, this is the first loan I did with him, people he knew looked at it and said, no, we're not interested. So he came to me, got referred from another realtor in his office, and I looked at it and I said, well, on its face, we really don't want to get involved in that property by itself because there's just too much work. And I didn't have any experience with him. I looked at the situation. He did have another house that he had as a rental that he just finished. I looked over that house. He did a great job on it. So I said, I'll tell you what. If you will let me put a mortgage on both properties, we'll give you the money you need to buy it and some of the money you need to fix it. He had to come up with the rest of the money to fix it. He really didn't want to do that. So I said, well, here's the situation. We're going to use that second piece of property until you get the property you're buying fixed up. And at that point, there's going to be plenty of value in that property to handle the loan all by itself. And then we'll just release the second one, or the other property. So he liked that idea. So he was just getting started in this whole rehab, holding properties for rent business. So he took a chance on us. We took a chance on him. But at no time were we really at risk because we had the other property and we had kept the loan amount low enough that we were always protected. He went ahead and fixed up the property, did a marvelous job on it, really worked hard, and we've been doing a bunch of loans for him ever since. So it made sense. We looked at his situation. I couldn't believe no one else thought of it. But we came up with it. It gave him the opportunity he needed, and he was a happy guy. So we all liked that one. And we sold that loan very quickly after that. Had another call from a gentleman who owned a small bar here locally, and he had an opportunity to buy another bar, a bigger one. That particular bar was basically double the size of the one he already had. It was on a very busy road, great opportunity for him, and the seller was giving him a good price. But he didn't have enough money down. So we looked at his situation. We said, well, if you're willing to use the small bar and put that in with the larger bar, we can add to the cash we can do, and then you can put some of your own cash into the situation. And then we sat down with the seller and said, we're digging and scraping wherever we can. Can you as a seller hold a mortgage for a year or two? We're going to give him a chance to get a track record, and then we'll be able to refinance him at a lower rate. He did. The seller was reasonable. She understood that we all had the best of intentions, and he got his bar. He went to a couple of banks, and they wouldn't even give him the time of day. We sat down and we tore it apart, and we got all parties to agree, and it worked out really well. And he pays perfect, and he's tickled pink. It's a good opportunity for him. Local entrepreneurs and business people had a couple of properties they wanted to borrow some money on because they were interested in buying some lots and doing a variety of things. As it turned out, one of the properties they inherited, and the probate wasn't done quite right, and so they were under a deadline to borrow this money to get some things done, and they didn't know until the end that the title company couldn't fix the problem. It would take another 90 to 120 days to fix the problem. So they were in a position where they were going to lose a good opportunity. So we looked at their situation, and in the process, I guess a couple of years ago, they had some commercial property they sold. The buyers put down a pretty good chunk of money, and then my borrowers held a mortgage for the rest. So I looked at them and I said, well, why don't we sit down and figure on buying some of the payments on the commercial mortgage that you have. We'll generate the cash you need in time for you to take advantage of that business opportunity, which he loved the idea. And so we did a quick title search, which came back fine, and we got him the money he needed, and he was able to move forward. After that, he got everything squared away on the original property. He borrowed the money he needed, and he's planning on paying off the payments that we bought from the mortgage that he held. So we had to ad-lib on that one, but we had to kind of roll with the punches is what I meant. But it served him well. He was happy. And he's been our customer ever since. To sum it up, keeping all the parties happy in these kind of situations, and it's not just the borrower, but it's the seller, and you've got sometimes a lot of realtors involved, and you've got the people who are processing at the title company. Sometimes you get a lawyer involved. To keep all those people happy and make them satisfied is not easy. It's not easy. Very, very difficult for me to even conjure up somebody who can do all of that besides our staff. It's just very difficult to find that these days. Besides that, you have to keep everything transparent. You have to be organized. You have to make sure that the end product is conservative. You got to eliminate the risk. So one day an investor comes and sits in front of you and says, please tell me about this loan. He has to be able to understand it. It has to make sense on how everything progressed. So keeping all of those things in order, again, is rare. It's very rare. Um, it's we love doing it because every situation is different, so the variety is good, but keeps you on your toes. One thing we've noticed is our type of mortgage, utilizing the creativity and flexibility, is becoming more popular every day. And you might ask why, but if you really think of it, especially now, as of this taping of in August of 2020, the classic business model is in a lot of cases been shattered, just been completely shattered. I mean, look at some of these businesses. Look at retail. A lot of stores and malls and in downtown areas where you'd normally go to shop are closing. Restaurants are closing. Look at taxi cabs. They're now being replaced by Uber and Lyft. Bank buildings. Their banks are getting away from their buildings. You see empty bank buildings everywhere now. Look at employees who no longer have to drive every day to an office somewhere and work and then drive all the way home. Now they can work from home and go in once a week or maybe once a month. The internet, look what the internet has done. And we're not done changing. Okay, this might be just the tip of the iceberg. But good businesses, the kind of people we like to loan to, are adapting to all these changes. That's why they're a good business. They adapt. Okay? Now, I can't say that for the banks. The banks are not adapting to all these changes. So more and more and more of these business borrowers are looking for us, Mortgage Investors Network, because they need that flexibility. Okay? We get things done. Whether you're a borrower or whether you're an investor, we like to think that we can help you either grow your business or get you a better yield on your savings, depending on whether you're a borrower or investor. I think that we use a common sense approach, but we get uncommon results. And that's what these borrowers need. So whether you're a borrower or an investor, never hesitate to call us with questions, whether it's in regards to loans or the mortgages we currently hold and the specifics of those. Don't ever hesitate to call us. We'd be happy to talk to you. Again, our phone number is 863-298-8777. Email is info@mortgageinvestorsnetwork.com. We appreciate you sitting through a fairly long video, but whether you're a borrower or investor, I think it's important that you understand how we think. Because when you're dealing with mortgage loans, very often you're dealing with a lot of money. We give it a great amount of importance, and I'm sure you do too. In any case, thank you for listening. We appreciate it and hope to hear from you soon.